that. Yeah, it cut me off right at the 8 o'clock hour. So.
Oh, no problem. All right. Yeah, Ansi, what you were saying?
We just wanted to, our members are asking how to reach you.
Yep.
Again, we have a lot of questions here. I don't know if you had a couple more minutes to cover
Yeah,
some, but
I have another 10 or 15 for sure. Then bedtime starts for kids. So.
hey,
Great.
hey, Valentino, what was that follow-up question after that one that you asked?
Yeah, absolutely. I got a question actually that I want to touch on, and it's quite important to me. How do you see ESG
Mhm.
factors influencing loans and acquisitions moving forward? And do you expect ESG considerations to impact future growth for companies reaching a certain size?
As it relates to the SBA world, I don't know that there will be big impacts. The SBA has always had kind of carve outs for women-owned businesses, minority-owned businesses, and veteran-owned businesses, but it's traditionally been on the startup side of things. So if I'm to guess where that the ESG would be impacted by SBA, it would be more in that space.
Mm-hmm.
I don't know exactly, because if you'd have told me a month ago that they were going to let equity roll happen, I'd have told you were crazy. But my gut would tell me you're not going to see it too much a benefit in the SBA world. If
Okay.
anything ever happens in that space, it would be more of likely a bank benefit, meaning they'd give a higher guarantee. Think of clean energy or solar panels or something like that.
Right.
If the government really wanted to juice that wheel in the small business arena, you do kind of what you do during recessionary times, which is increase the guarantee for the bank and decrease the costs for the guarantee fee for the borrower. I haven't seen that yet. There may be programs out there already, but I think the general acquisition space probably doesn't see that.
Great. Um, how does the due diligence process differ for SBA loans versus commercial loans when it comes to an acquisition? Are there any unique requirements for borrowers that they should be aware of?
So the process itself is fairly similar. You look at history. Most banks
Okay.
underwrite off of history, likely the last 2 years, sometimes three.
Mhm.
What you're doing in an SBA acquisition, as opposed to, say, a commercial business just buying a building, is you're having to sort of redo the financial stack for what the business would have looked like if the buyer had owned that business during those times. And by that, I mean, how much income does the seller currently take out versus the current buyer? What kind of expenses are they rolling through there? Are they absentee? Is there a need for some kind of management to come in?
Right.
Um, you don't really, it still always boils down to, in most SBA or conventional deals, boil down to, is there enough cash produced by the business to repay this debt? Or at least, if you're doing something like an expansion, are able to show projections of why this makes sense. There's not there is a bit of a misnomer that SBA loans take a lot longer than conventional loans. Anzi asked about cash flow lending at the higher levels. That's a little bit different. But for the small business arena, they don't really take that much longer if you're doing it with somebody who knows what they're doing. There's a couple of
Okay.
extra forms, but for the most part, it's a fairly similar length of process as doing any commercial loan. Typically, start to finish, from the day we get a complete package to the day the wire goes out, you're talking about 60 to 90 days.
Okay. Great.
And I say typically because that's in a good scenario. A lot of times what causes the delay
Mhm.
as you get closer to 90 than 60 is, more often than not, it's the seller. That's the slow, the one who slows that process down.
Right. How do banks handle situations where a borrower is acquiring a company with existing debt? Are there any potential challenges and solutions in these cases?
So there's two complications with that. First, well, there's several complications, but first and foremost, most debt that's put out there would put you in default if you sold the business for the seller. So if you're buying a manufacturing business where there's 4 equipment loans, for instance, depending on who did those equipment loans, you could put those loans into default by selling the business. So assume that the bank that lent the equipment was okay with the acquisition. Did I make sense there with the default? Would that made sense?
Explain that a little more.
So if I'm to do a loan for a business, and say it's a building loan, I'm doing a loan to that business, but also that individual behind that business. If that individual sells that business, you took one of the pieces off the table from our original agreement. So what you're likely going to see is the bank that has that note in place could say, no, we're not doing that. You're in default. Refinance us out. You need to leave the bank. In the case of equipment financing, where that would be more, I think it's more likely to present itself, you can do that, but the bank that's doing the acquisition has to be careful of, this is going to be, again, pretty inside banking, boring stuff, but any loan that's done has what's called a UCC filing on it. The easiest comparable I can give you, it's kind of like filing a mortgage on a business. Equipment vendors sometimes file specific liens against just their equipment, and they sometimes file liens against the whole business. If they did the latter of those, the SBA bank is going to have a problem with that because technically they're behind that equipment lender on all assets. So it definitely presents complications. It also presents traditionally cash flow issues because a business acquisition is a 10-year loan. That equipment loan is probably 5 years. 5 to 7 is the norm. So it presents a cash flow crunch. You're better off negotiating that equipment debt being taken care of in the purchase, meaning it's either refinanced or the proceeds from our sale have to go pay that debt off. It'd be pretty complicated to keep those in place.
I see. Let me talk about assets very quickly. I've seen construction companies where the seller claims they have $5 million worth of assets, maybe if they were brand new. But most of the times there's some depreciation involved.
Yep.
When an individual comes to you and they say, hey, I got $5 million in assets, I want an asset back loan, how do you clear it up to know what's the true value of those assets and how much you could lend on?
You would get a third-party appraisal. There's two mechanisms for lending against hard assets. One, the easiest is an appraisal, just like you'd get on a house. There are equipment appraisers. There are appraisers who do a specific type of equipment, very, very, if you had some kind of a laser cutting equipment, there's specific appraisers who can do those. The other one is you can lend off the balance sheet, certain banks, not all banks, but you can lend off the balance sheet assets. To your point, those are typically depreciated down on the balance sheet though. So the value probably wouldn't be there. I'm going to make up a number, but if you showed 2 million of true balance sheet assets, that equipment's probably worth more because you've taken heavy depreciation in those first years. It's also important to know that unlike an acquisition where it kind of all gets rolled in, if you're going to borrow against an asset, there's going to be an advance rate against it. So that 5 million of equipment assets, even if it appraised at 5 million, you're only going to be able to borrow something like 4 against it. There's always a spread there, just like on a home mortgage where you have to put 20% down to avoid PMI. A bank's going to have and they're always pretty uniform of like somewhere between 85 or 75 and 80%, whether it's a building, whether it's equipment, whether it's receivables, they're going to place an advance rate against it, which is effectively them saying, if this deal goes bad, we're going to sell this stuff. And hopefully that spread there was enough for us to be made whole. So It's not just 5 million for 5 million. It'll be 5 million at an advanced rate.
I got a question. In regards to the asset loan, assuming the $5 million without taking into account an appraising or depreciation on it, where do you think I would get the most value for my assets, so to speak? Bringing in somebody to do to appraise the assets or doing the balance sheet method? And what is the percentage difference between both?
It depends. The balance sheet number is going to be based on the amount of depreciation that the company took to offset tax liability over time. Heavy asset businesses, depending on a given year, you can have accelerated depreciation. Some years it's almost 100%, other years it varies. But the likelihood, I'm going to guess, it depends on the industry, but you're probably going to see a higher value based off of the true appraised value as opposed to the balance sheet. In order for that to be reversed, it had to mean you were taking less depreciation than the equipment was actually depreciating, if that made sense how I just said that.
Right.
Most business owners at the size that you're buying typically have less debt, and a lot of owners want this is the hard part of doing acquisitions based off just tax returns is what you usually have. most small business owners nowadays, because of, a 10-year plus run of good financials, because of all the cash that went through COVID, are typically sitting on a decent amount of cash and minimal debt. So their first thing they say to an accountant every year is, how do I minimize my tax liability? That somewhat manipulates the performance of the business, because you're no longer saying how much can I make? You're saying how much can I make without having to pay taxes on it. That leads them to buy excess equipment or do other things to sort of depress their taxable income. So when you're buying those assets, you should see that they took max depreciation that was allowed under the tax code. And typically that doesn't, the value of the equipment's more than the depreciated value.
Right. Okay. Let me ask these other two, just to close off, and then I'll pass it to Ansi.
Yeah.
I assume you have your deal breakers and your deal makers, things that you just see immediately and you're like, yes or no. Give me 5 deal breakers and give me 5 deal makers. If you can't give me 5, whatever you can give me.
Yeah. So deal breakers, that's always the way to start with it. Somebody who is trying to get into very complicated space and doesn't have the requisite background. Commercial construction, heavy precision machining, something else that requires a certain level. It doesn't matter if you're intelligent. It doesn't matter if you're a hard worker. If you don't have a technical acumen for a job that requires technical acumen, it'll hit you at some point there. You tend to want to see somebody who has some level of financial wherewithal as a percentage of the loan. So I wouldn't say it's a deal breaker necessarily, but if you have somebody who says, hey, I've got $50,000 to my name, I'm buying this business for $500,000, I have no personal assets, no outside income, this thing better work or I'm toast. That's not a very good position for a bank to put someone in. You'd like somebody who says, okay, I've got a little bit of personal financial wherewithal to sort of weather a storm if I have to. There's no real number to that. A lot of banks use 10% of the loan amount. So if you're borrowing $4 million, you should, in theory, have access to $400,000, be it through cash or home equity loan or something like that. I don't have a number that says that. Other deal breakers for me are deals that I don't think I can make sense of. I haven't done a whole lot in e-commerce because it's not a space I'm real familiar in, but a lot of those businesses tend to see kind of weaker cash flow and then all of a sudden go like this. That's not uniform, so that's not necessarily fair to say because I have done a couple of e-commerce deals, but anomaly deals where you have break even and then all of a sudden have 2 million of EBITDA. You got to make sure I have to really understand how that happened. There are banks that do it and I'm fine with that. And then I guess lastly for me, deal breakers for me are, some of it's on the personal level. If I don't feel like the person is being honest with me, the best thing you can do up front is say what you don't know. I always say this, my best strength is I know my weaknesses. Present those weaknesses to your bank. Don't try to talk around people. When you have a question, it's okay to say, I don't know. Let me find that answer out. There's no quantifiable way to say that, but somebody who you don't feel like is giving you the straight answer or being honest is going to make you just naturally say, okay, well, what am I missing then? What aren't they telling me? So, it's kind of a golden rule, I guess, but be a good person about it. If you're wanting to buy a business, you don't need to come to the bank hat in hand. The bank wants you just as much as you want them, but you do need to be honest and you do need to say, hey, here, as the call was getting cut off, I think I was saying my best value I can add in this process is to be somewhat, if I'm not negative, at least constructive. I want to be able to tell you, hey, have you thought about this? You might be the smartest person on the planet, but you don't have this technical acumen that this guy that you're buying it from does. People who gloss over those types of things tend to be, maybe it's not a deal breaker, but you tend to want to pull back from doing that deal. Deal makers. The easiest thing you can do is make a loan so that the bank doesn't have to worry about ever getting repaid. So if you have a nice personal balance sheet, you're going to be more lendable. If it's a really strong business, if it's recession, kind of an industry that's recession resistant. consistency over high growth for me. Yeah, I'd rather have a company that grew at 3% a year for the last 5 years than one that went like this and went up. People who have the financial wherewithal to run that business too. The both from a personal aspect, they have some, liquidity or outside income through a spouse, or they just really understand that business. Loan I'm going to close next month is a partner buyout. It's not a deal. This isn't really a deal maker necessarily, but you really want this guy to get this business. He's done everything right. He's worked, he's put his time in, he's saved up his money to do it. That person that did it right over time versus just right away going for it. People who shoot for the moon, more power to you. There are banks who will do it, but I tend to like, and the space that Ansi and I play a lot in, you see this a lot where people immediately go from, undergraduate, maybe work in PE, maybe go to graduate school and immediately say, I want to buy a business for $12 million. That's fine. That's not a problem. I think I have more power to people, but I've often told people, like, you're starting to play against professional money at that point. PE firms, family offices. There are hundreds of thousands of small businesses in this country that are smaller, and you can buy them more effectively and roll them up. So someone who has a strategy around it is always going to be more, attainable than somebody who just shoots for the moon right off the bat. I'm not saying people shouldn't, but as far as the easier to finance is someone who says, here's what I want to do over the next 5 or 10 years. But the real world of it is there is no maker or breaker necessarily. It is the 3 points I told you. Does the deal cash flow? Do they have the experience? And do they have the equity to put in? That's what makes a deal happen. Those 3 things are the makers of any size deal.
Love it. I just got a question from a viewer, and he's wondering, how is AI being implemented for loan application processing, if it has yet?
It really hasn't yet. At least I don't want to speak for every bank. There's going to be a point where that's a real thing. Where I don't know is a lot of commercial and consumer lending are very different. So I could see AI being applied to consumer lending more so first, because in consumer lending, for fair lending laws, it's much more formulaic. It's, you have this much income, you have this credit score, you have this debt to income. And I'm not a mortgage person, so I'm going to butcher this a little bit, but you either qualify or you don't. There isn't a gray area. Commercially, you have 2 businesses that do $2 million of revenue. They could look completely different in how they are applied. So I don't know how AI does that. It can do the simple probably, but the nuanced has to be done by a person right now. So I think where you may see it is banks will start to automate smaller deals, smaller being, let's just throw a number and say 350 or less. You might start to see you need less people and more automation at those, because you do have to churn those fairly quickly to make money off of them. Right now at most banks, to do a $4 million deal and to do a $350,000 deal, it's the same process. I shouldn't say most banks, a lot of banks. So, the amount of time it takes, the credit process, the write-up, all that is fairly similar. So what you could see is banks start to gravitate more towards an automated process for deals under a certain threshold. I think big banks do that already, not quite AI, but more automated. But I could really see that applying more on the consumer side first, just because it's a little more of a template to follow.
Thank you very much. I'll pass the mic to
Real
Nancy.
quick, we have a really important question here from one of our viewers.
Okay.
They ask, what is your lending criteria? And what industries do you lend in? Are you more industry agnostic, or do you have a few, like maybe top 5 or 10 industries that you prefer to lend in?
Yep. Good questions. Lending criteria. When we follow the SBA's SOP, which is the standard operating that they put out every year. There's certain cash flow thresholds you meet. And if you don't, what is good at a bank, the bank I work at, why I like it here, we have criteria, but those are suggested. And most of them are kind of like your baseline. So if our criteria is you need 1.75 cash flow, but you're below that, we can still do those. You just have to tell why. As far as industries that I don't do, our bank as a whole right now doesn't really do much in the hotel space. And that's out of capacity, not desire. We have a lot of hotels, and you can't have too big of a percentage of your loans in one industry. So as loans either refinance or naturally pay down, we'll start doing more of those. But for now, we don't really do hotels. The bank doesn't have this policy, and it's not a policy for me, but it's something I've learned over the years. I have tended to stay away from a lot of commercial construction that do big projects, where there is progress billing and where there's retention. My experience is those businesses need a ton of working capital. They can have great EBITDA and great debt service coverage, but if you're buying one of those, you need a mountain of working capital to get that business kind of through the first couple of years. Deals that have struggled over time, that has been a common theme for me of, contractors that are existing today typically have clean balance sheets and not a lot of debt and good working capital assets. If you're buying, you're kind of wrecking that model. It doesn't mean you can't get it done by any means. Just strategic buying one out, for instance, is a good example. But I'm going to hone in a lot more on working capital in that industry than I am others. And I would tell you this too. You asked, I don't think this kind of came up, but when you work with an SBA bank, one of the negatives of this space, to me at least, my background was in commercial banking. Like I said, I kind of fell into SBA lending. And as a commercial banker, you build a portfolio, you build a customer base, you meet with people every quarter, or at least talk with them, and you're responsible for that portfolio over time. If that company starts to struggle, you deal with it. You go to credit committee and talk about the business. SBA lending tends to be a little bit more transactional. So the experience I've gained over time is I have had to go through liquidation processes. I had to go through customers who have struggled over the course of 5 or 6 years. Most 7A lenders don't see that. That's on the back end. So I would always tell borrowers in the SBA space, specifically people doing acquisitions, but just generally speaking, don't ask me about the deals I've closed. I can always look good on those. I can make myself look like a hero on the deal that went well. Always ask your banker about the deals that didn't work and why. That's where you gain experience. What I try to bring to the table is take those experiences where past customers have struggled and let the borrower know, here's why, here's what I saw. A lot of times it boils down to the industry experience, the working capital, and the capital expenditures of that business. Those are three of the main things that I see businesses fail or struggle after they buy them. But people always want to hear from a bank about, tell me the deals you've done. Tell me your war stories of how you got things through. Anybody can bloviate on about that and make themselves look really good in those scenarios. Where you find the type of banker you want to work with is you talk to him or her about the liquidation process, how terrible you felt at the bankruptcy hearing, how awful it was to see someone lose their house. As I said earlier, I'm supposed to be somewhat negative in this process. I'm supposed to try to prevent the best I can that process from going through. It'll always happen to bankers. It's just a natural part of this. But I'd rather walk away from a deal even a deal I feel like I could get done at my bank. I'd rather walk away from a deal I don't feel good about because of those experiences that I've had. And I don't think most people in the SBA space in my role have that experience. So ask your bank about deals that went sideways or struggled at minimum, not about deals that went well. I learned, and that's part of my commentary on commercial construction. There are 2 deals in particular I can go into in depth on with individuals with a lot of time on their hands to go through it. But it sucks, quite frankly, to go through one of those. And it's a painful process, but it does shape who I am as a lender and how I go about things.
Great. No, that's
Awesome.
been amazing. I wonder, are those SBA SOPs available online by chance?
Yeah, you can Google them. It's mind-numbingly, it's exactly the type of reading that you'd expect it to be. It's like that thick. It's very legalese. SBA lending covers like I said earlier, a huge gamut of things too. So It's all readily available. It's, published every year. So I forgot how many pages it is right now. It's hundreds, if not, several hundred. So have at it though, if you want to read it.
And with that covered, essentially the way they have to operate for this year, or whichever the given year is, right?
Yeah. So it basically lays out the rules that the banks have to follow.
Okay.
Here's the guidelines of the criteria you qualify for. Here's what down payments are. And there's areas that are black and white, and there's areas that are gray. So banks have to interpret the gray areas. And so that's where you might hear one bank say things a little differently. It's not on the black and white ones. It's on the gray areas.
Thank you very much. Nancy, any last remarks?
Yes, we talked about this briefly, Colin, but our guest, a lot of people are asking what's the best way to get in touch with you. Now, you could either, let everybody know where to reach you, or we could make personal introductions to the one who are interested, just to make sure, these guys have solid deals, or probably in the they're negotiating the LOI before it's fully executed, right? So it depends on you, Colin. If you want to share your contact info now, best place to get to reach you, we could do that, or we could simply make introductions to the ones that we feel that are the best candidates.
There's my email address. I don't know if I'm doing it backwards for you or not, but it's cmcmurphy at fsbbank.net. You can also hit me on LinkedIn. And then whoever makes an outreach to you, just feel free to forward them. I do a lot of introductory calls for deals that end up not happening. I love walking people through the process. Clearly I want to close loans, and that's why you do this. But my experience is everything kind of pays itself forward. So if I spend a lot of time working with a person and don't end up doing their loan, historically, that's where some of my best referral sources have come from. So if you have people who are interested, have questions, it's a lot easier to talk one-on-one than it is on a podcast like this, and ask questions and then have follow-ups, because a lot of times people might have questions. I might have answered them, but they might have follow-ups and they just don't want to raise their hand a second time. So feel free to email me. Feel free to, reach me on LinkedIn, go through ONSI, however people are comfortable. I try to be as approachable as I can in this space, because I think most of us that do this take for granted that we know this and think other people do. When you do something, just like any other business, when you do something every day, you think people know things that they maybe don't. So I take a very approachable approach, if that makes sense, to this of, I'm expecting people to have questions, and I want them, just like, they always told you in school, there's no such thing as a stupid question. I'm a big believer in that.
Love it.
Great. So you guys, you saw the email, and be sure to reach out to Colin on LinkedIn. Here you go, right here, the email. And you can also reach him on LinkedIn. That's Colin McNulty on LinkedIn.
COLINMCNULTY. I often get Colin McNutty out of that. So if you want to, a thing you can start making fun of me for, it was painful every day. There was a substitute teacher when I was a kid, because if there's a body part you don't want to be named after, it was but the bank I'm at is called First Savings Bank. So I don't know if there's more than one Colin McNulty on LinkedIn, but I'm at First Savings Bank.
Thank you very much.
Appreciate it. Valentino, close us out, please.
Well, as you guys noticed, we had a very special guest. Hopefully he was able to answer your questions. Hopefully in the future we could bring you back for round 2. Any more follow-up questions for those who weren't able to get them answered. But again, reach out to him through his email. You can pause the video. Reach out through us. We'll refer him. Or through his LinkedIn. Colin, you've been amazing. I appreciate your time here. Hope you have a great